Talk Money to Me is a financial podcast produced by TransGlobal. All opinions expressed by the hosts and guests are solely their own opinions and do not reflect the opinion of TransGlobal. This podcast is for educational purposes only and should not be relied upon as basis for investment decisions.
Hey everybody, welcome to Talk Money to Me, where we talk about money and how it affects you. I'm your co-host Jonathan, and I know a little bit about finance.
And I'm your other co-host, Tracy, and I know almost nothing about finance.
We have two wonderful guests with us today. I'll go ahead and let them introduce themselves.
I'm Oriana Chan, and I am the mortgage loan originator.
Hey guys, it's Stephanie Wu again. Thank you for having me here. I am a personal finance enthusiast.
Today we're going to be talking about refinancing, and I know that refinancing is used in many other different types of financial services, but specifically we're going to be talking about how it relates to refinancing a mortgage. So to start off, I wanted to ask, how did refinancing come to be a thing?
Refinancing came from people who wanted to get a better loan on their current mortgage. Back in the day, let's say the 1900s, buying a house, you couldn't borrow the full amount of the house. You probably had to put 50% down and get a loan for 50%, and with
Yikes.
very high interest rates. When I bought my house in the 1980s, okay, my first house, my interest rate with perfect credit was at 10%. So I know there's a lot of people out there who still have very high mortgage rates. So now in the modern world, they want to eliminate all those high interest rates.
So then outside of getting better interest rates, are there other reasons why a person might want to refinance today?
A lot of people incurred a lot of debt, credit card debts, or they bought a lot of different cars with high interest rates. And
Who are these people? Why do they have so many cars?
a lot of the millennials. They live at home, but they have fancy cars.
Mariana sounds like she's speaking from experience.
And
Yeah.
they eat, and the millennials eat out all the time.
I feel a little bit attacked, but that's okay. I won't.
I know.
No, but seriously, a lot of people refinance to get some cash out to pay off high interest rated debts. Those are credit cards and cars.
Yeah, those are like the large ones.
Yes.
That makes sense because you're paying maybe a lower interest rate on your mortgage, and so you want to sort of consolidate the debt to a lower interest rate.
Yeah, and then like in addition to getting a better interest rate, you can also lower your monthly payments, or you can reduce your risk. You would usually change from a variable loan to a fixed rate loan.
Let's say I got a variable loan because I was like, risk all the way, and then I started to regret it as it kept going up and up and up. I could use refinancing to then renegotiate the terms of that loan. And so that's an option I could have if I regretted my decision.
Yes.
Awesome. I'm pro refinancing so far.
All right, and then the last reason, freeing up cash, usually is related to how much equity your home has, which is the portion of the home that you've paid for, and it belongs to you. So you can free up that money to pretty much do whatever you want with it. You can fix up your home. You can pay off other debts. So that would fall into like consolidating other debts. You can also buy a nice car if you wanted to. This is not advice, but it's also something you could do. So freeing up cash. So there's a lot of reasons why you would refinance.
If you use the equity on your house to pay off something else, you lose that equity, right? Because you're using it to pay for something else.
Yes, technically, because you borrow more from the lender, right? So the equity decreases because there's the percent wise your borrowing is higher, and then when you pay off whatever that other thing is, the money's gone. So yes.
It sounds like a game. Like I could rearrange all of my money so that like the stuff that I'm paying has very low interest, and the stuff that I'm spending is giving me return. And then if I do the cards right, then I could be it's like a giant money making machine that I don't even have to touch. Kind of. That's what it sounds like.
It definitely can be.
Whoa.
I mean, Tracy and I are both convinced about the benefits of refinancing at this point in time. But I'm sure that similar to any other financial products that we've talked about on this podcast, there's probably different types of refinancing. So could you give us a little bit more insight as to what those different types are and what they mean?
There are two different types of refinances. There's a limited rate and term refinance, also known as rate and term refi. Limited sometimes is just left out. And then the second one is a cash out refinance. Cash out we kind of touched up on in a reason to refinance. But for the limited rate and term refinance, an example we will use is, let's say you have a home that's valued at the market at $100 and you have $20 that you have in your pocket and you're like, well, I would like to purchase this home, but can't because I only have $20. But instead you can if you borrow the remaining 80% from a bank, right? So this is a loan, right? You borrow the 80%. But let's say that now several years have passed, and you're paying down the amount you owe to the lender. And you see that, okay, well, like right now, COVID conditions, interest rates are super low. I want to refinance. Remember that it was originally like a 30-year loan, but now you only have a couple more years on it, right? To pay off that $20. You can extend the term to be another 30 years just for the measly $20, making your monthly payment super low. Or you can get a better rate, and that would also make your monthly payments less. But you're only limited to changing the rate and term, meaning the amount, the $20 that you owe, you can only borrow $20 from the next lender, to pay off the past loan that you have. The other one, cash out, on the other hand, is you evaluate the equity that you have in the home. So if your home value, let's say it's remained the same, right? Over this amount of time, it's still $100. But remember, you did pay off an additional $60, right? So now your equity is total $80 and you only owe the lender $20. So that $80, you can again take out the equity that you owe, the $60 that you previously paid off, right? And go to a lender with a better interest rate, or you want to change the term, the amount of time you pay.
I like this. I think that it makes sense that as you're paying off a house, that you're actually just putting money into owning more and more of the house, right? And so you then could use the value of that money you've already put in to do whatever other things you want. That sounds like a way better deal than rent.
Yes.
I feel like I put a lot of money into rent and then get nothing in return except maybe some terrible conversations with my landlord. So this is maybe a PSA for everyone to go buy a house right now.
Yeah,
Yes.
Actually, right now, millennials are like, the timeline has sped up for a lot of millennials to purchase now because of the historically low rates.
That's a really cool. I didn't know. I had only known about rate and term refinancing, but I didn't know that you could actually cash out on the value that you'd already put in and utilize that for other things while continuing sort of like making your payments on your mortgage. I was wondering why like everyone feels like it's like they're paying their mortgages for the rest of their lives. But I feel like there's advantages to that too, because it means that other places you're able to pay off places like credit cards or something that have like a much higher interest rate, and you could just keep making payments into your mortgage. Like it's almost like it's an amorphous thing. Like your mortgage can be utilized in so many different ways creatively to balance out your other expenses, because technically you have equity in the house that you're paying off.
Mm-hmm. And and also to add on top of that, like you also get appreciation, right? So let's say that you decide to refi and then your home value doubles. Instead of $100, now it's $200. And so that you remember that you still only owe, after paying off that like $60, you owe the lender only $20. But because of appreciation, your equity is no longer only $80. It's actually $180 because of the appreciation.
Right. And equity is a percentage of the asset. That's crazy.
With my limited experience in finance, I've noticed that when I've looked at kind of the documents and papers for signing, sometimes I'll see interest rate and then right next to it an APR. But I
Yes.
thought that both of these things were the same thing.
No, they're
I
different.
guess. Okay. Could you kind of explain what those differences are for
Yeah,
us?
the interest rate that you see on your loan papers is your actual rate, and APR is your yearly rate. So let me explain what that means. Like every time you finance a house, a car, you're going to have APR rate. So basically, it's all the charges and fees and origination that's built into the rate already.
Uh-huh.
The APR basically tells you like what's your actual interest rate is.
Okay. So then the interest rate is like one small piece of the puzzle, and then the APR is the full complete package
Yes.
of how much you owe.
Yes.
When it comes to getting a mortgage, I remember on the previous episode you had explained, kind of the process of getting pre-approval and,
Okay.
making sure that you're in with the right people. With a refinance, do you also have to do kind of a similar process too, or is it easier or maybe harder?
Yeah, you have to decide on several things. What is your goal, basically? Then you got to decide on the loan amount, how much you want to borrow, and for how long. Actually, I think age has a lot. If you're young, I mean, you can go with the full 30-year loan, right? If I'm going to refinance, if I'm ever going to refinance again, it's going to be for the shortest term because I would want to pay it off. Because when I retire, I do not want a mortgage.
So you have to think a lot about kind of your current life stage and how much time there is left before you want to not have all of these burdens and extra worries. It's
Yes,
like, how much
correct.
can you take on in how much amount of time?
Yes.
Well, and also I think, at least for me, I haven't had a lot of things that helped me build a good sort of credit mix or a good a history of credit. So the type of loan I could get is probably affected by that too, right? Like
Yes.
how much credit I have.
Yes.
They won't even give it to me even if I wanted it.
Yes, the general rule is that you have to have 3 lines of credit. One has to be over 2 years old.
Is it possible for when you're refinancing that you have a better credit score now than you did when you first took out the mortgage? That then you get a better rate because you have a better credit score now?
Yes.
Oh,
Only if you've been paying on time.
Yes.
which we
Yes.
always do because we talked about this. We talked about this in our credit episode. What a push for listening to season 1. Am I right? Am I right? That is amazing. Are there any situations where like refinancing is a bad idea? Because I feel like Jonathan and I are super sold on refinancing now. It's super cool. I'm glad it exists.
Yeah,
But,
all
like,
the cool kids are doing it. Anyone who's
Right.
anyone is doing it.
And they're calling it refi. No one says refinance anymore.
You're
No,
right.
I'm just
Yeah.
kidding. But are there instances where it wouldn't be a good idea to refinance?
Yeah, if you have a good interest rate right now, it depends on the interest rate and if you need cash. If you're
Yeah.
Oh yeah, that makes sense.
if all your debts are paid, you have no debts.
Yeah, and you're not
Right.
looking to invest. You don't have a plan for that money. Then I wouldn't recommend doing it because if you don't have that plan, you're like taking out that money, but then you're paying a lot of interest on it. Or I mean, not a lot, but like it's still interest. You still have to pay it.
Right. I turn down deals all the time here because there's just no benefit for that person. If I'm only saving you $20 a month, it's no benefit.
It's not worth the hassle
Yeah.
and the extra costs. Stephanie, you had mentioned how kind of like because of these historic lows from the pandemic, a lot of millennials have been purchasing homes. So it's actually possible that later on down the line, even though they have the option to refinance, they wouldn't simply because they're historic lows now. So what's the chances of it getting even lower in the future?
Yes, but I could see it potentially needing to cash out. Like me myself, like I would cash out like for investment purposes because we are young. We do have time on our side. Investing early is a good idea, and so I like myself. I'm just saying this is like what I do. Okay, I did cash out one of my rentals.
To me, then it sounds like one of the most viable options for cash out is if you know that you're going to make money off of the cash that you cash out. Right, like, because if you just cash out, I mean, obviously there's life circumstances where you're like, oh shoot, I need cash
medical
right now.
bills,
Right.
emergency.
But like for someone who is just kind of like, I'm bored, let's refinance. Which I don't know if anybody does that, but
It's a long process. I don't know. People.
I'm the type of person that might one day suddenly have a spur of action moment where I'm like, yes, I will do all the things right now. But it sounds like if you're going to do that, then the only way to make that worth it is to make sure that you make money off of the money you cash out.
It depends on the loan amount too. If you're only going to cash out 20, 30, 50,000, I don't think it's worth your while. You might as well get a home equity line of credit. It's free, short term, or any term you want, actually. It could go to 25 years.
It's a line of credit, so kind of like a credit card.
Yes.
But your home is collateral.
Based on your equity.
Okay.
So be a homeowner today.
Yes, be a homeowner today. Go buy homes.
Yes.
Buy. With that, we'll go ahead and draw this conversation to a close. Thank you all so much, guests, for coming to speak with us today. And we hope to see you guys at the next episode. Take care. Bye.
Bye-bye.